Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, just curious about it, or you've been in the industry for years, well, we designed the Gray Report especially for you as a YouTube show and podcast to provide you with the most important and up-to-date information, whether that's data, articles, and original opinions to help you make the most informed and best decisions in investing and in business. You're going to want to watch the whole episode. Subscribe to the Gray Capital YouTube channel for more. Stick around because we've got some great reports that Matt has put together for us. We're talking about a lot of outlooks for 2023 and beyond from RealPage, Marcus & Millichap, Berkadia, Moody's Analytics. Again, strap in. We've got a great episode of the Gray Report. Let's get into it. All right, everybody, back to the report. I'm reporting live on location in Oahu, Hawaii, doing a little bit of research and a senior Gray Capital leadership retreat, or we can call it that. Matt Bosnagel, though, co-host, director of communications and marketing at Gray Capital, holding the headquarters Gray Capital office back in Indianapolis, holding it down. How are things going back in Indy, Matt?
It was a balmy 60 degrees in January yesterday. So, yeah, it's actually really nice here. Not as nice as as your background. That is, yeah, I feel peaceful just looking out at the sea.
Trying to bring some tranquility to the viewers. Okay, so Matt, this is an exciting time of the year because especially for the Gray Report, especially because all of these end of the year reports or predictions for 2023 are coming out. So it's providing us a lot of good stuff to talk about. Some of it is, I would say, not new. It's stuff we've been talking about every week here on the Gray Report. Some of it there are good insights into trying to paint a picture of what this next year is might turn out into, because everybody's got an opinion on this year. Usually it's comprised of a couple different shades of the same story, though, of that it's going to be, it's not going to be an easy year. Is that your take, Matt?
I think that's true. I think that there was nothing that was really dramatic about these trends. Nothing that people, not huge doom and gloom, but a little bit gloomy. Not, so it wasn't disaster, but it definitely wasn't, sunshine and roses. I think that there is this general uncertainty that has persisted, and that has made it very difficult for people to make really consistent and like the bolder economic predictions than we have. That being said, it's hard to make too much of a case against like kind of a little bit of a stable, maybe it's stagnating a little bit, but I don't think it's gonna be horrible out there. That's just my top of the head.
I agree. I don't think it's going to be as horrible as some of the worst case scenarios that some folks are painting. And I also get a sense that nobody wants to be the one that comes out and say, maybe things aren't going to be that bad, because you feel like you're going to be exposed and people are going to roll their eyes at you and say, like, you don't get it. You're not seeing it. This is going to be horrible. Storm clouds are on the horizon, and you're just, too short-sighted to see the dangers that are out there. But I think that, you can be aware of the dangers, but also kind of look at the reality and not just completely retreat. I think you can be more defensive, but you don't have to completely retreat and say, hey, no, it's too scary. I'm not going to do anything right now. Which I think a lot of folks are in that category.
Mm-hmm. And I think that if 2023 is anything like 2022 was, and it could be in some ways, there may be moments where there's growth in the air and maybe moments when there's not. And this could be kind of a second little transitionary year where we're still trying to find our footing, and the conditions are not going to be uniform throughout the year. A lot is going to depend on the Federal Reserve, but I think there are also some of these economic stories and economic trends that haven't really matured completely yet. So we may be in for a few more shifts. That being said, and I know you did mention that it is a little bit scary to make these predictions, or a little, you have to go out on a limb. There's a little bit risky. And so I'll always be here for an organization that's ready to put their prediction in print and say what things are going to look like in 12 months. That's not an easy task. You don't want to embarrass yourself, and you don't want to, to make yourself seem inaccurate or less credible. So again, I respect the companies that release this information and really submit themselves to the chance that they might be wrong.
Well, let's just jump into some of these reports, Matt. Starting with this one from Moody's, and there's tons out there. I mean, I think I've seen lists of dozens of reports that financial institutions are putting out. We're just highlighting a handful that I think are more relevant to the multifamily industry, kind of real estate, kind of sum things up. But let's start with this. Let's start with this Moody's piece. It came out recently, and Moody's is not dedicated to commercial real estate solely, or especially multifamily. They're covering a wide range of asset classes and alternative investments, including commercial real estate. But just to kind of sum up, and this came out on December 30th, apartments struck a balance, office demand plummeted, and retail remains flat. So now they didn't mention industrial, but apartments are in a seemingly good spot relative to the rest of the economy and other commercial real estate asset classes. Now they did a quick little bullet point summary of what summing up the year and where things are. And I think most people understand the stock market's down, interest rates are up, housing demand is down with high interest rates, and we've had some negative rent growth and absorption over the last several months in the multifamily sector. But Matt, what are some of your takes from the Moody's piece? Anything that pops out?
Yeah, just to come back to the economic context just for a second, there were a few, and we talked about a lot of these last week. But a couple of new points that this one made that I'm sure aren't really a surprise to anyone, but are worth mentioning, is that one is that supply chain stress has eased up, and gas prices are, at least for now, down from the year's high point. It's hard to conceive of a supply chain that's not in a tangled crisis, but it seems like things are getting untangled. And I remember hearing, this was like even a couple weeks ago, that one of the supply chain cost trackers that was made during the pandemic, that's actually showing that we're closing in on normal, whatever normal means. But it's not as much of a problem as it is now. I that's not to say that it is that previous supply chain stress is not working its way through the economy through whatever, construction projects or, business balance sheets, whatever it is, like that's going to have a lagging effect. But on the ground level, seems like it has eased up. I think that there's a Chinese COVID outbreak that may affect this, may not, but at least for many indicators, it is supply chain.
It's better than it was.
Yes, exactly. Secondly,
it's
labor
better than it was. Yeah. Well, just real quick before we move off supply chain, just a quick point is that I think some of the pandemic related bottlenecks, they've been easing, but I think the longer term story is the restructuring of global supply chains to make them more geographically diverse and resilient. And so some of that is going to be onshoring here in the United States. But again, it's more diversification where companies saw 100% of their manufacturing coming out of China, and then that's it shrieked to a halt during COVID. And that's maybe it's not bringing everything back to the United States, but maybe they only have 40% of their manufacturing in China, and 20% in Vietnam, and another 20% in Mexico, and 10 in the United States, and you're in several different markets, and that can be more complicated. But I guess what I keep coming back to, Matt, is the world is still flat, and the advantages of global capitalism and being able to get the best price, I don't think are going away and can't be ignored. Now, I think that we're going to be in a more mature global economy because we understand what the risks of supply concentration. So I think that's going to be more inflationary over a medium to longer term period, because it may be a little bit more expensive to manufacture some of your goods in the United States or other countries, or just may cost more resources to have multiple manufacturing operations, but you don't get the bottlenecks maybe at the next pandemic in 100 years or whatever the next black swan trade war, whatever it could be.
That's a good point. Planning for a 100-year event is it's a little weird.
We're always fighting, we're usually fighting the last war, but it's probably not a bad thing to.
Oh yeah, for sure.
So enough supply chains.
Yeah, and then the next point, and you can kind of see it down here, is the idea that labor. Maybe there has been some tech layoffs, but I think that the bigger story is that it has not yet imploded. It's almost like people are waiting for bigger layoffs than there already has. And I do think that it is notable that labor has been sustainably high. There are other sources that we'll go over here that will talk about the importance of job growth to a particular multifamily market, but job growth in general is good for the economy. It's good for the multifamily market. And it doesn't seem like we are facing something horrible in 2023 when it comes to the labor market. Maybe a little bit of stagnation, maybe things
that's what people keep coming back to. Yeah. It's like, how are we in a recession? We've talked about that we could be in a recession, or that we were in a recession, but the fact that the labor market is still so tight and unemployment is so low, and we are seeing wage increases, how do you call yourself in a recession? That being said, anecdotally, there are certainly some high profile layoffs in the tech sector, in the financial sector, that make people think that maybe we're going to see more layoffs further in 2023 if we really have a recession, and that maybe we're early. But man, we're starting from such a low place, and again, that's speculation. Could it happen? Absolutely.
That's a good point, and it's almost like if I'm worried about something, it seems like there could be more layoffs. These could spread. It seems much more worrying on that side of things, rather than like a situation where the labor shortage exacerbates and becomes kind of a wage price spiral. It seems like we're tipping more towards a bad employment situation rather than a kind of scary inflation situation. But that's my pessimistic outlook. I don't think we're there yet, though.
We should be, no, I agree. I don't think we're there yet. And another factor that's going to cut both ways is that a lot of wage increases were triggered at the start of the year. A lot of individuals had pay increases that would go into effect January 1, or some of the new minimum wage laws that were passed went into effect January 1. And so we're going to see, a little spike in, total, wage growth in the start of 2023. How inflationary is that, or if it's on the margins, I think it's yet to be seen, but I think we're still going to see a tight labor market. But do some of the cost of labor also get to a point of where employers are going to have to start making some strategic decisions of, who they really need and who maybe they don't need. And then also it's how much of that is in preparation for a potential downturn versus we're in the downturn and we have to reshuffle. Because if looking back, if you're in a recession, you'd love to have said, well, we should have gotten rid of, X percentage of our workforce a quarter or two ago and been able to save cash. But, you don't have the luxury of going back in time. And so our CEOs, assuming there's going to be a recession and making some of these decisions in anticipation of the downturn, which makes the downturn that self-fulfilling prophecy that we always talk about.
So I thought about that, and I put some of these ideas in a later part of the notes. But there does seem to be this kind of like bunker mentality, whether it's driven by fear or whether it's driven by like the need to kind of prepare for the future. But I think that some of this bunker mentality, yes, uncertainty, and they don't want to, they don't want to bet on an uncertain future. But it could also be interest rates are making it harder to make those predictions in the first place. It is driving people to be less expansionary and more, stick to what you know. And so, as a discrete and tangible effect on the economy, that seems a little bit more persuasive than fear. Although, high interest rates makes fear a very easy to act upon, I guess.
Yeah. No, it is just that uncertainty. And it's also with interest rates moving, Matt, it's changed the discount rate on how, businesses are valued. And that's hitting the tech sector the hardest. And kind of getting back to the similar idea is that, you have companies like, Tesla that are down 70%. The tech companies all across the board. I mean, if you're a Apple or Microsoft, maybe you're only down 30 to 40%. But tech companies are really reeling, and so part of that is they're looking at their new valuation and how do these CEOs and CFOs how do they climb back to getting a little bit of a better valuation? How do they get that cost per share up? And one way to do it, just like no different commercial real estate. You got to increase your net operating income and your revenue. And one way to do that is, to increase net operating income is to decrease expenses. And for a tech company that has a huge payroll, paying people hundreds of thousands of dollars for, maybe a half a week's worth of work, or, very kind of cushy jobs that probably some of them weren't 100% necessary. And they're saying, well, look, we have to reduce our payroll. And because their shareholders are looking at them saying, hey, we're down 70%, you got to do something. Investors see, okay, they're reducing their payroll, they're going to have wider margins. That should be reflected in the stock price itself. So I think some of these layoffs are really trying more financial engineering that, and also probably a little bit of, if your company's down 70%, I would feel like it's a recession.
Yeah.
And that's what I would communicate. And you certainly don't want to say it's my fault or something the company did is why we're down 70%. You'd much rather say it's, macroeconomic forces that have caused this.
Yeah.
So.
And then finally,
anything else on the macro on Moody's?
Yes. There's one more thing in it, and it is kind of in the same vein, is that average credit card debt is inching upward as an indicator that households are increasingly cash strapped amid soaring inflation. This is an interesting, and I've heard other sources talk about how, all of that wealth that we've gathered during the boom times post-pandemic or late pandemic, that's kind of eroded largely. And I think that this is a data point that shows that we've kind of drawn on all the wealth that we had saved up, and maybe we're hitting a point where things are starting to hurt a little bit. That's a kind of a good news for inflation, that people are starting to feel pain, but it creates more risk, more vulnerability, and that's we don't want an implosion. So it's another worrying and uncertain sign for the future. Great.
Yeah. Matt, my one comment on just the beginning of this report is that, while they did have some figures near the top, I feel as though that it was lacking some citations and data that kind of near the bottom of that list. Like I would have loved to get some actual data on average credit card debt is inching upwards. Well, okay, inching, what does that mean? On the labor comment, that's just a comment to Moody's, but being a little critical. But anyway, we digress. Let's go on. Let's talk about multifamily commercial real estate, what Moody's has to say.
Yeah, let me just run through the commercial real estate, and then we can stay on multifamily just for a second. So their take on CRE, and again, I'm going to put multifamily last. So office Demand is weaker, both from steadier remote working policies and lower corporate profits. Demand went from 3 million square feet in Q3 of 2022 to negative 7.13 million square feet in Q4. Again, what you said about the figures is right. I would take these figures with a little bit of a grain of salt and kind of follow it up. But the general story is that demand went down. I think the economic factors as well as the working arrangements, those are both kind of converging now and resulting in lower demand for office. Retail is a little bit of a brighter spot. It's kind of interesting because they do note that the pandemic did keep people at home, and it did lead to a big rise in e-commerce that kind of took away from brick and mortar retail. But retail real estate did not fall as precipitously as it did in the wake of the 2008 financial crisis. Consumer spending is at healthy levels, and neighborhood and community shopping center net absorption was up 44% in Q4 as compared to last quarter. So it's pretty good. And this is the story that we have been seeing. Office has significant challenges and probably is going to be transformed really in the next few years. Retail had challenges, but not transformative, completely disruptive challenges. It may emerge from this a lot healthier than what would have been expected for a pandemic that kept people at home for so long. Yeah. And then now to multifamily. It leads off with this idea that national multifamily supply and demand both cooled. They say to their lowest level in 2009. But Spencer, you have sagely noted that some of the exact figures behind this cooling may be off, and it deserves to be corroborated, I guess, with other sources.
Yeah. Well, when I was going through the report, and they mentioned that I'd love to get comment from Moody's, but basically that total construction delivery and net absorption only reached 100,470 units and 135,472 units for the year respectively, the weakest record over the past decade. Now we were on track at one point, Matt, to deliver over 500,000 apartment units in the United States. And it was widely reported that we were falling short of that 500,000 plus number. I even saw reports it was going to be in the $600,000 range, 600,000 unit range. So this 100,000 unit, just being 20% of what was forecasted, and well below, I guess, for some of the reports that we've covered on the Gray Report that were more in flux. I think the number is going to be coming out somewhere in the mid 300 to 400,000 unit delivered range across the country. So 100,000 units is significantly below what I was anticipating, and so I don't believe the number is correct. And I believe we have some figures from Berkadia and several other sources that point the number at much higher, still well below what was anticipated. So Matt, you said this very correctly earlier. The story, the narrative on this Moody's article is correct, but some of the numbers, I almost wonder if they grab some of these numbers from a market or a region or a quarter.
That makes a lot more sense,
because they're not, they couldn't be national yearly numbers. And I would even say even in that office section, they were saying that what was 1 million square feet delivered or something. That's like a build. That's a large building, or a couple large buildings. Yeah. And so to me, and again, anecdotally, I think we should look into those numbers. And so again, not that this Moody's article doesn't have good narrative, it has some good information, but it's one of those cases where you really need to just take all the information with a grain of salt. And I'd recommend on any of these reports, take them with a grain of salt. I mean, now you've covered, and we're tracking, the discrepancies in these reports from whether it's a rent growth or some of the other KPIs, and some because they have different methodologies, and that's fine. But this would be a discrepancy that is beyond a variance in methodology and much more just looking at the wrong data set, I think.
Yeah. Yeah, that's what it did seem like. It was not as robust as other places. And again, Moody's is covering all of these sectors, and it's a little bit more maybe of a mass market of investors than people that are specifically multifamily focused. But even so, so it was strange. Like their information on the specific markets, they had the biggest winner for multifamily markets was Knoxville, and then the biggest loser is Memphis, both in Tennessee. I just didn't think, Knoxville had 19.3% year-over-year rent growth, and Memphis is at negative 0.7%. I don't know. It just seems weird to me that there's such a difference. Now, I don't know that much about Tennessee multifamily. I was just the general story is something that I'm more interested in, and their general story noted that a lot of the markets with falling rents were pandemic darling markets. I can get behind that. It's just when you dig a little bit of the details, it's a little different.
Yeah, I agree. I mean, this is the first time I've seen, I think, Seattle in a top spot for effective rent growth. Now, it is effective rent growth, not market rent growth, which we're often looking at market rent growth. But yeah, it's a little bit of a different list than what we're seeing across other sources, I would say.
Yeah. Now, I did use in my notes this discussion of markets as a nice segue into the RealPage article. If you're comfortable moving on from the Moody's piece.
Yeah. So where do we want to go? RealPage?
All right. So yeah, RealPage. Carl Whitaker has written a really nice report that talks about 3 types of apartment markets that could outperform in 2023. Just to overview the 3 types, and then we'll get into each one. College towns, markets with outsized job growth, and affordable low beta markets, which we'll get into kind of that definition. Just to kind of start out with college towns. And again, I also want to note that I like this again. This is they're putting themselves on the line, just like Berkadia is going to with their predictions. They're saying what they think is going to happen in the multifamily market, and I think it takes some confidence. So, with that being said, I'll begin with college towns here. So he didn't. Now, I haven't followed student housing as closely as market rate multifamily housing, but other than the fact that student housing charges per bed, but maybe deals with additional risks, renting to messy students, I'm not as plugged in as I'd like to be. However, I think that a lot of college towns with large and robust universities, they're going to be fine. But I'm not sure that a given market will simply succeed because it is a college town. Some of the headlines about higher education make me think that there might be reduced demand for colleges in coming years. That could be years down the line. Maybe we'll see healthy growth in college towns for the next 5 years. But beyond that, there is a narrative. Now, I don't know how true it is, but there has been less demand for higher education. Some of the businesses are not hiring as many people. They're not requiring college degrees at the rate that they used to be. Now, these could be small little changes that are overblown because someone needs to write an article about it. But it does give me some pause. And there could be some changes down the line, especially when you're talking about if there's lower population of students in general, then
it's a good point, Matt. And I just pulled up some just like initial research because I was like, I'd be curious if that anecdote, lines up with what's going on in the field in terms of less people going to colleges because maybe that value, that return on investment isn't there. Mm-hmm. And, this is from Statista.com. Let's show what this actual source is. Well, we have to get anyway, so we'll confirm this source, but from Statista.com, undergrad enrollment in U.S. college universities has been dropping every single year. So you make a good point of just having a university in your town may not be enough of a driver. It might be okay. And I guess where I come back to is it's like any market. You never want to have just one industry. Yeah. One business, one factory, because that one factory either goes out of business or just, stalls and stops growing. You have too much concentration risk. But what I do think is very attractive is college towns with additional economic drivers in those college towns that may be linked some way, but not directly or inherently to the university or the college, that have other industries going on. They don't have to be huge industries, but you want to have, couple different cogs and gears in the machine. You just don't want one driver. You want to have, whether it's manufacturing, tourism, information, IT, tech, something else going on, because the university itself is going to have, it's going to have spillover effects in terms of, there's support staff, and there's going to be restaurants for the students and the staff, and there's going to, there's all of those crossover secondary, tertiary effects. But we all know the college town that just has the college and university, and it's like kind of stagnant, and again, thinking close to home, I'm thinking of like a Greencastle, Indiana, where like DePauw University is. I haven't checked the population growth on Greencastle recently, but I think it's relatively flat. But compared to a Bloomington or a Lafayette, West Lafayette, that has not only, universities, Indiana University, Purdue University, but, down in Bloomington, there's a variety of the other industries, whether it's medical device manufacturing, advanced manufacturing, like mining from limestone, all the quarries down there, from the Crane Naval Research Center that's down there that employs a couple thousand people, to Purdue, where they have this massive research and technology park, Alcoa, Subaru, a lot of other manufacturing. So there's a lot of other things going for that rather than just the university, but the combination can really be a good recipe for success for a good market.
Yeah. And also, I think that not all universities are going to be subject to the dire straits that may or may not happen in the next few years. What I've heard will tend to happen is the smaller universities that are not, kind of name brands. I think that DePauw will be fine as a university, but there are some that are significantly smaller than even that will fold. And other places like the research universities and these large kind of long-standing prestigious places where people continually go, things will be largely the same. It's not like every university will suddenly have 90% of their previous demand. It may be something like 10% of the worst performing colleges may not be able to operate.
That's a good point. And I believe there have been some universities like in the last year or two, small colleges or small universities that have shuttered the doors for exactly what you described, Matt. So very good points.
So those are the college towns. And then the next section are, and this is no surprise, but it is definitely worth mentioning because it's, if you don't mention it, it seems like it's downplayed. But markets with outsized job growth, those are expected to perform well in 2023. I think it's worth mentioning because not all of these markets with outsized job growth did particularly amazingly in 2020 through 2022. So those 3 years, San Francisco never did amazingly well. It had a bump up after doing very poorly in 2020 in the first half of 2021. But I
don't think San Francisco is an outlier because of other stuff San Francisco related. But agreed. Yeah.
But these markets like Dallas, Fort Worth, Miami, Las Vegas, New York, all of them had way different rent growth trajectories during the pandemic, but they all share this huge job centers. It's like, don't count them out. Something major has to go on to count them out for 2023 job growth. And I think Carl Whitaker rightly points out that even in the case of places like Las Vegas or Riverside, which have seen falling rent, the sizable job growth that they're still experiencing will keep these markets stable. Maybe almost like put a floor to these declines.
Yeah. Well, yeah, I agree. Just because of the amount of demand in those markets, and you may have years of oversupply because developers seeing that demand, but it tends to even itself out over time. You're seeing necessarily some of the markets. Well, Austin, I put like Austin and Phoenix. I'm looking here. And Nashville into the category of they've just seen so much explosive growth. They were all mid to large size markets that are getting bigger, mid, medium, large. And that's where you see that volatility of, you see a huge boom years like we saw in 2021, and now we're seeing in a lot of those markets declines, and where, again, there's some markets that just behave a little bit differently. Again, it goes to show having a geographically diverse portfolio is a really smart way to manage risk and to limit volatility just within your multifamily portfolio itself. There's markets you're going to get great growth in certain economic conditions, and then other years where you're going to see some declines in growth in others, and there's going to be some that are just stable and some that are going to be volatile. And that's why you also want to be diversified through the different economic bands of multifamily as well, because different demographics behave differently in different economic conditions as well. So having some workforce housing and some A-class assets, I think, is a smart move. The challenge is to the amount of work that is involved in building that type of portfolio. If we're just talking about a multifamily diversified portfolio, the different sponsors and opportunities you need to find, that can be the challenge.
Yeah, that and that is actually something that I was thinking of, is like, what are the robust jobs that are going to, what is that economic band that is going to be the most promising or the most stable and resilient in 2023? I think when you come to markets, and this is kind of skipping ahead or for the next section, which is these affordable low beta markets. This is the Midwest story that we've kind of come to welcome and expect. This has the steadiness that I was kind of referring to. He doesn't say that these are 100% Midwest by definition, but there's certainly a regional correlation. Cincinnati, St. Louis, Indianapolis, Kansas City, Cleveland are all in the top 10 markets for quarterly rent growth. But like the high job growth markets, they're not all the same. This is just going off the map, and I use an external source. There's an apartment list rent report, but Indianapolis has had more rent growth since the pandemic began than the other markets that are the other Midwestern markets here by a significant margin. So they may be all relatively low beta, which, as Carl Whitaker explains here, low beta implies that there's less opportunity for growth, but also less risk of decline. That may be true of some of them, but I think that there are others where you may have more of an upside than a downside. Specifically, I'm talking about Indianapolis, of course. They had more rent growth than places like Cincinnati, St. Louis, and Cleveland, or even Kansas City. But one thing that all of those markets have going for them is that the cost of living is lower, the rent to income ratio is lower, and there's lots of room for them to move up in rents. We talked last week about the kind of price convergence for rents, and if we are approaching this moment where people's wealth is winding down, they're drawing on credit a little bit more, their rent is becoming a little bit more of a burden for them, they're going to seek out, at least on the margins, places where cost of living is cheaper.
Yeah. So, especially if you're someone who's looking at a more defensive stance, in general, whether that's now or always, I think some of these Midwestern low beta markets are great choice. And in general, when folks are looking to put multifamily as a piece of their portfolio, it often is a relatively defensive position in general, or at least the thought and the goal is defensive. And what ends up happening though is that you have the advantage of being in a very defensive position, investment that's tax efficient, throwing off cash flow, but you also often enjoy a lot of the benefits of growth as well, and some pretty attractive upside. And I think that can be the case regardless of where geographically you are investing. You can hit some home runs in the Midwest. You can hit some home runs in the Sun Belt. The chance for hitting home runs in the Sun Belt may be higher, but the volatility may also be higher as well. And so, again, thinking about building and constructing that portfolio, maybe it's a combination percentage of these high growth, high job growth markets, that you maybe are going to have less cash flow, but you're hoping you're going to hit a triple or a home run on them with some cap rate compression. And then another percentage was 50, 60, or 40 of these just low volatility, higher beta markets, such as Indianapolis, Kansas City, Columbus, Ohio, Cincinnati, Virginia Beach. I wouldn't include. I'd throw Miami in the growth column for sure. I think Miami may be maturing a little bit. Miami has I'm sure there's going to be a slight correction in Miami, but it's not yet. There's still some people moving to Miami because I think that the pandemic really just solidified people's decisions to accelerate that retirement and moving from New York City down to Florida. I don't think a whole lot of people are moving back, at least from a permanent residency standpoint. There are folks that move to Florida from New York who are still going to be living in New York for just slightly less than half of the year, but their permanent residence is set up in Florida because they don't pay New York taxes. Who does?
Yeah. I agree. I think what I was thinking of when I was thinking of the jobs that may be more sought after or more resilient in 2023, but also kind of these markets will be more resilient in 2023. In an uncertain time, you kind of want to go to a place where there's a little bit less risk for a downside, and not only is there maybe less risk, but during these times, these markets perform better. It's not just that it's less risky. It's in the beginning of the pandemic when the market tanked, it was Indianapolis that was running to the top of the markets for rent growth. It wasn't like they were just steady. They were actually better than other ones. So this may be another year where these steady low beta markets are actually the highest growing markets, period. So if we're in that uncertain,
Matt.
Well, yeah, I know. That's my hot take. I can't take in as many predictions and not give one of my own. So, and that's what Carl Whitaker says himself. He said, with expectations for a softer 2023, don't be surprised to see a few places, such as the aforementioned Midwestern markets, sneak into the top 10 for annual revenue growth by year's end. So I'm not alone. No. He may not say, he doesn't say Midwest, but I know what he means.
We know.
Yeah.
We know where he's going.
That's right.
All right, good stuff. All right, so on this Berkadia report, Matt, this is a really nice piece. We look forward to this report. A little bit of issue on rendering our PDFs, but through some technology, we were able to decipher some of the, the overlay of text on the PDFs.
I think the word is palimpsest.
Is that the terminology?
That's right. There's a English major word.
I was gonna say we needed to bring in the doctor.
That's right.
Get a diagnosis for the PDF.
Yeah, that's right. This is a long report. It's like 150 plus pages with individual projections for a bunch of different markets. But for our purposes, the national trends section of this report is a little similar to Moody's report in that it gives a nice tidy summary of what's going on. Only instead of looking at Q4 2022, Berkadia is making some predictions for 2023. Some of the sharpest and clearest predictions rather than kind of implications of trends, they're really nailing down. And here are the top line figures. By the end of 2023, according to Berkadia, there will be 3.3% year-over-year rent growth. By the end of 2023, there will be 95% occupancy, which is down 70 basis points from 2022. The rent share of wallet is expected to be 23.7%, which is up 10 basis points. I don't really like the term share of wallet. I think that a rent to income ratio is much cleaner. I think share of wallet is a little bit more of a comparative figure, more of a moving target than income, but I kind of digress there.
Is share of wallet and rent to income the same thing?
I looked it up. Share of wallet is used as a general term when you're kind of comparing consumers' pricing decisions from one product to another, and I was unable to figure out what the wallet is because sometimes the share of wallet is referring to business, sometimes it's a consumer, sometimes it's the cash they have available. But when you're talking about a share of wallet for a necessity, I don't know where the discretionary income comes in there. So
yeah, that's what I was going to say. Is that after they spend everything else, but but the percentages are too much in line with rent to income ratios. I'm assuming that's the primary rent to income.
And I think that that's their main point, is what is the impact? Is the impact going to on renters? Is rent going to seem more expensive or seem a little cheaper? And it will seem slightly, like 0.1% more expensive. So I would say that's fairly even. I'm not gonna, I don't think that's a dramatic prediction. But I don't find any reason to disagree with it.
One of the bigger stories that has been not really talked about outside of the Gray Report and some other housing experts that we follow, Matt, is that while the headline is rent growth is up, and the rent is too damn high, it's up 20%, 30%. When we look at rent to income ratios, they have not moved nearly as much as that story would suggest. And so is it incomes are rising? Is it the makeup of the renter demographic? You're seeing higher income earners coming in, so they qualify for more. If we're looking at an average or mean versus an average, or an average versus a mean, if you have some people that are making hundreds of thousands of dollars that are renting, quite a few of those, you're taking the average, that is going to offset the rent to income ratio. So it's an interesting metric, and I think, again, surprising that rent to income or rent share of wallets has not. They are not as unaffordable as the narrative may be.
And what we may be seeing, and this is only, and I'm only speculating this because of what you said, we haven't seen that dramatic drop off, but what we might be missing is affordable housing. A lot of these numbers, like from RealPage and Yardi Matrix, their purview and their data set is market rate housing, and it's not anyone in like affordable housing or kind of subsidized housing or anything like that. And maybe that is where people are really hurting. And it does make sense, because a lot of the new supply for housing is not affordable. It is market rate. That's another complaint that affordable housing activists are saying, is like,
that's true. But like, if you in like affordable housing, though, your rent is typically capped at a percentage of your income. And I could see it makes sense so we don't have enough affordable housing, so people who would typically qualify for affordable housing are spilling over to market rate.
Mm-hmm.
But that should bring the rent to income ratios up. So I agree. I think it's definitely we don't have enough affordable housing. There are people being stretched. I'm wondering if we're looking at like average numbers, and the median is much more appropriate. I don't know if we're looking at average or median.
Yeah, that is interesting. I'll have to look in and look at the topic of affordable housing rent to income ratio specifically. I wasn't as informed about how they kind of calculate rent as a percentage of their income.
Yeah.
So that's the share of wallet fact. And kind of moving on from their overview and predictions. So this deals with absorption and deliveries. So in 2022, absorption was at 15,185 for the year, compared to 401 deliveries. Now that delivery number is over 3 times more than the delivery number.
360. Okay. Yeah, we're on the
totally. That's definitely accurate. Now, so that was 15,000 absorption, 360,000 deliveries. Now for 2023, Berkadia predicts 403,000 absorption and 565,000 deliveries. Still more deliveries than absorption, but it's not such a huge mismatch compared to last year. I think that Berkadia is specifically projecting that this greater number of deliveries will be the result of many pandemic delayed projects finally completed in 2023. That's an interesting take that I've always kind of taken the reverse, is that, we've had these delays and these delays are going to continue, but at some point these projects will get finished. And I'm wondering whether that's going to result in like, a high, it's like a high pressure and then it'll peter off, or whether we're just gonna see a little bit more, a little bit more, a little bit more for years and years and years.
You know,
So
on the other
I'm not,
side of that, yeah, and the,
yeah.
the other side of that, Matt, is that, you know, developers have slowed down. I mean, there's a ton of projects that are in the pipeline, but less and less, you know, permits are being filed for new projects kind of going forward. So after this deluge, you know, there's concern that, you know, we need to keep building because we still need more housing. And again, the interest rate uncertainty has made a lot of developers just take a little bit of a pause, you know, try to finish the projects that they have going. But what happens, you know, when they stop, there's a period where we cut these deliveries in half. I mean, we're digging our way out of a hole. We're adding to the units. You know, again, we need about, you know, anywhere between 4 and 6 million housing units over the next, you know, 5-7 years or so. So, you know, dropping in, you know, 500,000 a year is going to get us on our way, but we actually have to build 500,000, not say we're going to build 500,000 and build 300,000. So and if we stop and we only deliver 250,000-300,000 a year, that really pushes us even further away. And while that might be good in terms of returns to an apartment investor, it's not good in terms of finding that healthy balance between supply and demand and having adequate housing supply in the United States.
Yeah, I think that these numbers seem like a little bit optimistic in terms of deliveries, but still, it doesn't make me think that we're getting close to being oversupplied. And then finally, when it comes to cap rates, Berkadia didn't really go out on a limb here. Cap rates were 5% in 2021 and 2022, and in 2023, Berkadia expects them to be 5.1. On one hand, this does make sense a little bit. The steady conditions of the apartment market will likely bring investors into the market. But on the other hand, if there is a critical mass of apartment owners that are compelled to sell because they're facing steep interest rate increases, we could, for a moment, maybe not a whole year, we could see cap rates expand more than the 10 basis point. I think that
I agree. I'm sorry. I'm just laughing. I'm looking at this chart of cap rates, and you know, if this is if there would ever to be a non-scientific anecdotal you know, projected forecast, this would be it. To think if anyone that was alive during the last couple of years and have been paying attention to multifamily, does anyone think that cap rate, what they're saying is cap rates have been flat for the last 3 or 4 years. Does that sound right to anyone? Because it's not. If you don't believe or weren't aware that there was a major drop in cap rates between the beginning of basically 2019, the beginning of 2020 through 2021, then you weren't involved in the industry during that period of time, and Berkadia certainly was. Now, they don't want to go and say on their report that cap rates are going to be in the 5 to 6% range, even 6.5 to 7. And so, since they don't want to say that, they can't say that cap rates dropped to 3.5 to 4% in 2021. And so, instead, they have it at just a 5% for all of 2021, all of 2022. No volatility, no price correction. Besides, now in 2023, we're going to go up, 10 basis points? Or
I mean, there's a publication interest, but I do wonder, it smooths out a lot of things.
It's nice and smooth, but also, like, where are they getting this number? They're literally I highly doubt that any of these numbers are actually data driven at all. They are numbers that they are taking, like, at best a survey amongst brokers, or most likely they're asking somebody to fill in what they think the average cap rate was for that year. And it's just an anecdote guess, not a guess. It's an educated rounding of where they would like to present where the market is was.
So, and this is and I'm just looking at this. They have that line graph that shows where cap rates went from 2017 to 2023, and in between the years of 2019, when the cap rate was 5.5%, to let's say 2021, which was where they could have arguably been the lowest. It was 5%. So it went down 0.5%. When maybe, do you think it should have gone down maybe a full percent or okay.
Yeah.
Interesting.
And then I think that they're in 2022, cap rates rose 50 to 75 basis points as well. If not maybe 100.
Yeah. Interesting. So I do think, this is again the story versus the numbers. On the one hand, there is this interest rate thing, and there is the possibility, and I know you said last week it could be later in the year of 2023 where people could in the market be selling. But on the other hand, it's not like investors aren't waiting with bated breath and salivating mouths, waiting to eat up any kind of deal that they can find, especially in a condition where people are looking for a safe hedge against any volatility elsewhere in the economy. So I could see it. I still think that your argument, though, is the argument that interest rates have not and will not be kind to cap rates. I think that story is a little bit more dominant and compelling as a way to project where cap rates are going in 2023, rather than things are going to be the same.
My only point is that there's just been more cap rate and price volatility than that figure represents. And cap rates, there are no really good sources, especially for national cap rate information, because national cap rate information is only somewhat relevant and useful anyway. I mean, it's nice to talk about, but there aren't really any great sources for cap rates other than really firsthand direct knowledge, either from a broker or yourself, getting it directly from an owner, because CoStar doesn't have the right cap rate information. CoStar sucks on Yardi Matrix. It sucks on all of the other brokerages, unless it's a survey where people are actually saying what they're seeing in the market. Those are a little bit closer, because I mean, I've talked to brokers that say that they give incorrect cap rate information to these research institutions. They don't want to have their prices figured out. They don't. So it's garbage in, garbage out, hardly useful. So honestly, it's the only use in this case is talk about how just be careful getting your information on cap rates from just one source. Matt, all this is reason why people need to be subscribed to the Gray Report, whether it's over at GrayCapitalLLC.com. You need to sign up for the newsletter. GrayCapitalLLC.com/newsletter is a great place to do that. Hop on over to the Gray Capital YouTube page, or where else? I mean, GrayReport.com. If you're a credit investor, you want to invest with us, you're the Gray.fund. But we want to make sure everyone's staying up to date. We need to stay up to date, and we appreciate you watching this. Matt, any closing comments? Any remarks?
Rent growth at 4% by the end of 2023. That's my prediction.
Go. I think, totally. I think,
not bad. It's not bad.
I think, between 3.5% to 5%, probably between 4% and 5%. Again, where?
That's right. Yeah, that's right. Exactly. Nationally.
Okay. Everyone make some smart decisions. We'll catch you next week. Talk to you soon. Thanks for watching the Gray Report.